Hello friends, today's topic from 15 years Japan and China markets flat. Will it happen in year 2? Question mark. I am Dr. Bharath. Purpose of the video is Financial Educational Society. Just because we are making this video, it doesn't mean that it will happen in India too, because it is one of the points of view. India is a developing country. Unlike India, Japan and China are developed countries, whereas India is still a developing country. In view of it, for the next few years, surely we will be having a lot of improvements in stock markets. Japanese stock markets gave almost no returns to shareholders if somebody invested a lump sum amount at the peak in 1990. Nikkei index value was around 38,900 in December 1989, and in February 2024 it crossed the 39,000 mark. However, with the overall weakness in global stock markets, its value is around 35,000. Here is a graph of Nifty index showing a sideward movement. This is a very peculiar situation for stock markets and is not common. However, if you observe, if any investor had done an SIP during the period, he would have still made decent results in the long term. The following is the data for Japanese economy. As per data, Japanese GDP has grown by an average of 0.9% per annum in the last 20 years. The country is itself growing at a very slow pace, then the companies will also grow at a lower percentage, hence minimum appreciation in stock markets. The average age of Japanese population is around 50 years. Almost 30% of the population are above 65 years of age. The older the population, lesser spending by people, since the requirements are lower, and hence lesser business for companies, and hence lower potential of stock market appreciation. This is the reason stock markets of rapidly growing countries like India give higher appreciation than developed economies like Japan, UK, USA, etc. So the Japanese stock market index hardly giving any returns in the long term seems logical after considering about data. However, the following is another interesting graph which shows that the similar trend has happened in Chinese stock market between 2009 and 2025. You can see in July 2009, the index was 3,400. April 2025, it is 3,300 only. That is the Shanghai Composite Index. Although investors who did regular investments such as SIP would have still made decent returns, it is not encouraging when you see an index that has moved in a narrow range for 10 to 15 years. During this period from 2009 to 2025, Chinese GDP growth rate has been an average 7.3% per annum. So in spite of good economic growth, the main index of the Chinese stock market has given negligible returns. As per our study, the lack of good returns for the Chinese market is due to 1. Many of the largest Chinese companies are government-owned companies which often prioritize government policy over profitability. 2. Financial reporting and corporate governance practices are sometimes weak and not transparent. This reduces investor confidence. 3. High regulation and frequent government intervention in the markets creates unpredictability. 4. Foreign investors face restrictions on accessing Chinese markets. However, things have improved slightly in the last few years. So, will a similar thing happen in India markets too, when there will be no returns in the long term for the next 10, 20, 30 years is a question mark. Although nobody can predict the future 100% accurately, there are some factors which makes flat returns unlikely, at least for the next 20 years. India is also enjoying the benefit of demographic dividend. It refers to the growth in the country economy due to the change in the age structure of a country's population. A country that experiences reducing birth rates along with low death rates receives an economic dividend or benefit from the increase in productivity of the working population. Around 50% of India's population is aged below 25 and around 65% of the population below 35 years of age. The average age of an Indian is 29 years compared to 37 for China, 40 for US, 48 for Japan. It is around 8 to 10 years lesser than China and other advanced economies. By 2030, higher percentage of India's population will be in 25 to 45 group, most productive phase of one's life. During the period of demographic dividend, GDP growth is high, per capita income increases, and a higher portion of the population is in the working age group. Once the population starts becoming older, then the positive aspects of demographic dividend reduces, and finally, lesser percentage of people are earning, lesser taxes are collected, and overall lower consumption of goods and services in the country. This is what is happening to Japan since many years. So, as per the studies, we can expect decent to good economic growth for another 20 to 25 years, at least in India, after which India will become fully developed and the GDP growth will be on the lower side. This is why the central government is targeting to become a fully developed country by 2047. Hopefully, the stock market growth also will be good during the period. It all depends on the joint efforts of the government and the productiveness of people in the country. As of now, Nifty has been growing at an average rate of 12 to 13% per annum. It will continue at a similar range for another 20, 25, 30 years, and later it will reduce to around 8 to 10% per annum. By then, bank FD rates would have reduced to 3 to 4% per annum, and savings bank interest rates would be only 1 to 2%. Inflation will also reduce significantly. We need to take maximum benefit from stock markets since the coming generations may not get such high appreciation from investment since the overall growth of India would have slowed down. End of the video, here is the question. Do you think Indian markets will give negative or flat returns for the next 20 years? You may type yes or no. In case you are not the member of this channel, this is the time to subscribe, press the bell icon, send the video to all your friends. The video is good, press the like button. Thank you for watching. Bye bye. All the best.